All right, guys, good morning. In today's video, I wanted to do a follow-up on the video I did yesterday titled Hedging a Leverage ETF Holding TQQ by Selling a Call and Buying a Put. Um, I have a subscriber, his name is Glory Days, and he really comments a lot, which I very much appreciate that. And so he was trying to run through this strategy that I was doing, and he said, just checking whether I understand correctly. The call option comprising 100 shares of TQQ can be executed at 170 for an initial price of 19.35 per share, which means that the TQQQ price must be at least 170 plus 19.35, which equals 189 in order for you to make a profit. Correct. So, just a couple things before I get into the nuts and bolts and the explanation. So, options can be really complicated, with puts and calls and the strike price, expiration, and then where the shares need to be in order for you to make a profit, the Greeks, the percentage of profit, all that. So what I wanted to say though, before I get into it, is sometimes in investing in options trading, it's good to be a street smart guy as much as an academic. And so I remember this quotation, I read it a while back, and I was able to find it. It was in an investing book, and it's on David Tepper. So investors that I feel that are kind of street smart or street wise or wily, like Carl Icahn, David Tepper. In real estate, you have like a Ben Mala. He also, and it's a lot of these New Yorkers. I don't know if Tepper's a New Yorker, but Icahn and Mala, I think, are both from Queens. A little rough around the edges. They may be highly educated too. For example, Icahn went to Princeton and read philosophy, right? I'm not sure where Tepper went, maybe Pittsburgh or Fordham or something. We can look that up. But actually, there was an instance when he was arguing with one of the founders of an options model, Fisher Black. So Fisher Black here, let me pull him up. It is the famous Black-Scholes equation. So you see also Robert Merton is a big options person, an economist as well, but Fisher Black. So we go back here. I'm going to quote here. It says, on a few times when he argued with Fisher Black, one of the co-authors of the Black-Scholes option pricing formula, Black said that the debt was overpriced and he should buy the equity instead. Quote, Fisher, if I listen to you, I'm going to be fired. You're probably right over the long term, but in the next 3 months, I don't think you're right. If I listen to you, I'm going to get killed. And so that's kind of David Tepper in the arena, contra more of a professorial type. And so that's something to keep in mind with options, with investing in general, is, there are textbooks, there's instructions, and then you have to look at things, analyze things from a very basic level. And so what do I mean by that? I think also maybe, Glory Days, you're looking at it, and maybe you didn't see it exactly yesterday, so I'm going to go over it again, as if I were purchasing TQQ at the 145 and then selling the 170 call. And so that's how you would do that option equation. But again, looking at it from a street smart way, here's how I'm looking at it. I'm going to pull up TD Ameritrade here, and you have to understand that my position or cost basis is not where it's trading today for those 100 shares. You can see that these 100 shares I was paying right in here in the 18s and 19s. Okay, so when I'm selling that 170 call, I bought it at 19. I'm selling it at 170. I'm not purchasing 100 shares at one where it's trading today. It's showing it's 144. So I'm not purchasing shares at 144 to sell it. It's a covered call. I already own those 100 shares. All I'm doing is I'm saying, wow, the market is frothy. So I'm going to, my gain right here is 637%. Let's say selling at 170 is going to be a 750%. So I'm going to guarantee myself a 750% if it continues to go up. Maybe again, it goes to 200 and I lose a little bit of profit. But I can guarantee you, any investor, it's a win for them to buy something at $18 or $19 and sell it at 170 and make a 750% return, whatever that exact number would be. We're at 637 right here. So that's how I'm looking at it. Okay, so you can see here, I'm going to pull up Robinhood, and the reason I pull up Robinhood is their options is pretty cool because I don't use it. I have like a small account, maybe with a few thousand that I had just opened. But with their options, which is cool, is they show you, like TD Ameritrade options doesn't show you this. This is where I'm going to put. Let's go to the call first. So you can see here the 170 call on June 17th, 1925. This is for today. It's going to be slightly different, but it's trading around the same, so it's not going to be much. The total credit is 1925. Okay. And then look, it kind of shows you on Robinhood, like if it's where it's trading, TQQ price expiration, what your profit and loss would be. You can see here expected profit and loss above it. So you can kind of get a sense on what the options formula or calculator there. Now, again, this is going to calculate, though, just so you know, right here, the TQQQ price today. And then if it goes to the 170 strike, anything beneath that 170 is full profit. I make the 1925, and then there's going to be you're still profitable. It's going to calculate it. Yeah, I think in your comment you said the 189. I think where you're mistaken though is my cost basis is not 146 or 143. My cost basis is $18. $18. That's my cost basis. So hopefully that explains the call side of the situation. And now let's go to the put. So we have okay, so let's go up here. We have the 115 put, June 17th, 2022. The cost basis is about the same as the call yesterday, so they're almost a wash, 1920. So basically, your max profit on this it's showing is 95.80 max loss, meaning your max loss is limited to the premium you're spending at this moment. Meaning you're either going to be able to exercise it or you're not. There's not unlimited loss on this. And it's going to show, again, the break even. This is what you were trying to figure out also in your comment, I believe. If it's at 144 today with the premium, if TQQQ goes to 95.80, you're at a total break even. Now, if it goes beneath that, you're in profit. So if in June, again, we have a market crash and TQQQ is trading beneath 95, you're going to have profit. And again, this is just kind of, to me, I'm looking at there's a market crash. So remember, I bought it at $18 or $19. It's 144. If we have a market crash, to me, it's certainly conceivable that a triple leverage ETF could go back to 18. So if it goes back to 18, it's showing down here at, if it went down to zero, what you would profit. I mean, it's unlikely for it to go to zero. But this is, I believe, just on the value of the option. But remember, I did the calculation yesterday on, since I also own those 100 shares, what a put does, it enables me to sell 100 shares at 115. So again, if I own 100 shares and my, it's trading at 20 and I'm able to sell it at 115, do the math on that of, the upside. Remember, I purchased it at 18 or 19 and I'm able to sell at the 115. So it's just kind of the real exposure here, the way I see it, Glory Days, is it's limiting my upside. And I basically took the premium from the limiting of my upside to get a free insurance policy on the downside. Now remember, this is only for one contract. It's only 100 shares. So I'm having that other 100 going. So that other 100, if it goes to 200, I get the full upside of that. On the downside, if it crashes, then I'm in for a little bit of a ride. But yeah, I hope that explains a little bit more. And you can use. I would look at Robinhood. I don't. I think I have again $2,000 in this account. I don't use it, and the reason being, like, I know that for the interface is really nice. I like M1's interface. I used to love Motif. M1 reminds me of Motif, even the same color scheme. And Robinhood's interface links, especially with options, especially with this cool calculator, you're able to kind of do what you were asking, and figure out what your real exposure is instead of pulling out a calculator like what's your max profit, max loss, where your break even is. It's very helpful to have that. So kudos to Robinhood for adding that into their option toolkit there. So yeah, so that's pretty much it for today. Glory days. I know options can be very confusing. I would just continue to watch a lot of different videos on options, order some books on options. And for me, I kind of, this is a little bit more complicated, but I generally don't do this type of stuff. I generally just do cash secured puts, covered calls, a ping pong strategy, which is often called the wheel strategy, where I sell the cash secured put. If I'm put the shares, I sell the covered call. I do it with things that oftentimes with an implied high implied volatility. That's what I'm trying to say there. And so that why sometimes the premium is richer. So that's pretty much it. So again, any questions, feel free to comment, and really appreciate you interacting, Glory Days, with the likes and the comments and subscribe to the channel. Hopefully you're doing well with your investing and you're gaining value from this. Take care. Ciao.